This year will mark my 10th year in the real estate industry, and while that's nothing compared to guys that have had 30 plus year careers in the space, at this point I've seen and been through enough to start to see some patterns that tend to show up over and over again. Whether that's through preparing materials to try to get deals past an investment committee in institutional settings and seeing how some of the most successful and seasoned investors in the industry look at deals, or through my own real estate investments and mistakes and successes I've had along the way, there are some common threads that I found among deals that have worked out well and other common threads among deals that haven't worked out so well. So in this video, what we'll do is sum up 5 of the biggest lessons I've learned around the practice of decision making in a real estate investing context and how to improve the decisions you're making when looking at new deals of your own. So life is a series of decisions, and if you're watching this channel, one of the decisions that you've probably either wrestled with in the past or wrestle with on a day-to-day basis is when to invest in real estate, what specifically to invest in, and how much to pay for a given real estate deal you have your eye on. And unlike trading public equities, the price you pay for real estate is negotiable and you have control over the operations and the business plan of the asset you're investing in, which introduces a whole new set of variables, personal responsibility, and pressure around the decision that you're making. So to help take some of that pressure off and help you make better decisions when these scenarios do come up, in this video we'll walk through 5 of the biggest lessons I've learned throughout my career to make better decisions on real estate deals and how you can implement these same lessons as a framework to run your own decisions through on new acquisition or development opportunities. So the number one point on this list is a pretty cliche term, but that is to look for the low-hanging fruit. In my experience, the easiest deals to pitch to institutional capital are the deals that have clear upside potential that will both increase rents and value of the property, and that upside is easy and inexpensive to execute on. A commonly used applicable example of this is adding washers and dryers to a multifamily property that already has laundry hookups in each unit, but the actual washer and dryer appliances themselves aren't included for the renter. For the added convenience of having pre-installed washers and dryers, tenants are often willing to pay an additional $30 to $50 per month in rent, and the cost to install those washer and dryer units generally isn't more than about $1,000 per unit for the owner of the property. And an additional $360 to $600 per year in rent to be generated on a $1,000 investment is a 36 to 60% return on cost with extremely little risk to the investor, and especially if this is done at scale on a larger multifamily deal, the total value of these increases can have a significant impact on cash flow and the overall returns generated at the property. The same thing is true for things like turning unused space into paid storage, increasing the cost of things like parking fees to be more representative of market rates, or other small items that have a very low cost and effort to execute on and very high rental upside in comparison to that cost. And the more opportunities you find like this where you can drive value with very little effort or expense, the more you tend to de-risk your investment as a whole and increase your chances of success on the deal. Now, next up on this list, and my number 2 point here, is another strategic play, and that is to use your competitive advantage and stay in your lane. The most successful real estate investors are the ones that know the operations of a property type inside and out, or know a specific geographic market like the back of their hand, and they stick to their expertise and do that one thing very, very well. Very few investors or investment firms are experts in multiple product types because of the amount of knowledge and experience it takes to be successful on a large scale. This is why you see most small to medium-sized real estate investment firms only focusing on one specific asset class and location, whether that's West Coast multifamily or office buildings in the Southeast, or specializing in niche product types like data centers or self-storage. To find good deals, it takes a tremendous amount of effort and focus to create and maintain broker relationships, to see enough deal volume to understand patterns and operational norms in a market, and to have the systems and infrastructure in place to be able to run with those opportunities and have a competitive advantage over other investors in the market. In my experience, the most successful investors focus on getting really, really good at just a few things and then spend their time and energy continuing to improve their knowledge, relationships, and building their portfolio in the geographic markets or product types they're experts in. Now, aside from staying in your lane and finding the low hanging fruit, the number 3 point on this list is something that I think is more relevant than ever today, and that is that someone will always be calling the top of the market. Back in 2014, when I first started my MBA, I can't tell you how many speaker panels I went to where someone said, "We're in the eighth inning of a 9 inning ballgame." I've heard these same types of comments every single year since then, all the way up through 2020, when finally, for a select few product types and markets, those people calling the end of the cycle were finally right. But in the meantime, the people and companies that started sitting out back in the early 2010s ended up missing out on a tremendous amount of growth in real estate rents and asset prices during that time, and also missed out on the experience that inevitably comes with 6 or 7 years of operating real estate assets and building relationships in the process. So yes, at any point, someone might be right that a market crash is coming or that we're headed towards the end of a cycle, but considering we've only seen property values fall during about 2.5 years in total over the last 25 years in the US, chances are that sitting out of the market actually presents more risk to would-be investors than actually being in the market in the first place. Especially if you have entrepreneurial goals, the last thing you want to do is wait out a crash only to have that crash never come and that dream never materialize. I've known way too many people who are unhappy in corporate environments, many of which are really good at what they do, waiting to strike out on their own when the downturn happens, but by the time the opportunity actually struck, they had golden handcuffs on or life circumstances that prevented them from doing what they actually wanted to do in the first place. All you can reasonably do is use the data you have about current and projected supply and demand fundamentals and make the best educated decision that you can today. And listening to everyone's predictions of a doom and gloom scenario will only keep you paralyzed and prevent you from taking any action at all towards what you're looking to achieve long term. Now, the fourth point on this list is another strategy point, and that is, when possible, do what you can to find deals with downside protection. As some of us learned the hard way in 2020, things don't always go as planned, but if you have a worst case scenario that you can live with and potentially even profit from, that tends to tip the scales in your favor when looking for a profitable deal. This could mean that you're a debt investor with significant operational capabilities so that if you do have to foreclose on a property, you're confident you can turn that property around and ultimately sell it at a profit. This could also mean that you're buying a commercial property with upcoming lease expirations and you know that those leases are well below current market rates, meaning that even if the tenant doesn't plan to renew at current fair market value, that gives you the opportunity to go out and find a new tenant at significantly higher rents. This could even mean buying a multifamily property with a tenant base using government-sponsored housing vouchers, giving you rent collection assurance even if unemployment figures spike like they did in 2020 and a large portion of your property loses their job unexpectedly. When making decisions on whether to move ahead with a deal or not, think about your downside scenario and whether that's capped or if you can see your downside as potentially being an upside scenario after some releasing or turnaround efforts are made. And finally, to add one more cheesy quote to this list, the fifth part of this framework to make better real estate investment decisions is to skate where the puck is going, not where it has been. The vast majority of investment memos I've put together throughout my career, either to present to an investment committee or raise capital from individual investors, have included an entire dedicated section on how the market or submarket is changing and the new developments that are planned or under construction in the area that will benefit or hurt the deal we're looking to build or acquire. Knowing that a major company is going to lease space right across the street from an office property you're looking to acquire, or that hundreds of multifamily units are being built on the same block as the retail deal you're taking a look at, or that hundreds of multifamily units are being built next to an existing apartment project you're considering acquiring, can help you spot opportunities that will pay off in the future and help you avoid significant risks that could actually hurt your property value going forward. This also means understanding things like where future transit lines are going, knowing the major tenants with interest in a specific building or submarket, and even major political or regulatory changes that may have a direct impact on real estate in the market. The most successful real estate investors evaluate a submarket based on what it is today, but also what it will be 5 to 10 years in the future, which can help you frame your own decision-making process when looking at new deals. If I've learned anything during my time in the industry, it's that making decisions that leverage your strengths, have favorable risk-reward ratios, have some mechanism of downside protection, and factor in future developments give you the greatest chance of maximizing your upside and minimizing your losses in the real estate game. And if you want to learn more about the real estate investment analysis process, make sure to check out Break Into CRE Academy, which will give you instant access to a library of pre-built acquisition and development models to practice analyzing live deals, 19 courses on commercial real estate investment analysis and valuation, and training on how to build your own acquisition and development models from scratch in Excel. And if you like this video and want to see more content like this on this channel, make sure to hit the like button to let me know. And if you've been in the industry for a while, let me know in the comments the main things you consider when making investment decisions and some key lessons you've learned along the way. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.